The first step is to understand why firms even think about paying out cash. The classic Miller-Modigliani dividend irrelevance theorem says that in a perfect market, no taxes, no transaction costs, and investors can create their own cash flows. The value of a firm is unchanged whether it pays a dividend or reinvests earnings. Think of a pizza. Whether you cut a slice now and eat it or keep the whole pizza for later, the total calories are the same if you later eat the saved slice. The bird-in-hand argument, Gordon, 1963, counters that investors prefer a certain cash payment today to an uncertain future payoff, because the certain dividend feels like a safer bird in hand than a future growth promise. This creates a premium for dividend-paying stocks. The tax preference theory, Miller, 1977, flips the story. If dividends are taxed at a higher rate than capital gains, rational investors will favor firms that use buybacks, which generate taxed gains only when shareholders sell. Imagine two ways to get money from a friend. A cash gift taxed heavily versus a loan you repay later without tax. The latter is more attractive if taxes are high. Agency and signaling theories focus on conflicts between managers and owners. Managers may waste free cash, the agency cost, so a dividend or a buyback forces them to return cash, reducing the room for overinvestment. At the same time, a change in payout can signal private information. A new dividend may signal confidence in future cash flow, while a buyback can signal that the stock is undervalued. Dividends lower the number of shares outstanding only when the firm repurchases stock. A simple dividend does not change share count, but reduces retained earnings. The impact on earnings per share, EPS, and return on equity, ROE, can be illustrated with a balance sheet example. Assume a firm with net income equals $100 million, 10 million shares, and equity equals $500 million. Before any payout, earnings per share equals 100 divided by 10 equals $10. Return on equity equals 100 divided by 500 equals 20%. If the firm pays a $10 per share dividend, total $100 million cash out, equity falls to $400 million, but shares remain 10 million. New earnings per share equals 100 minus 100 divided by 10 equals $0. Return on equity equals 0 divided by 400 equals 0%. The firm looks far worse on these ratios even though its operating performance is unchanged. Hence, dividend payers often face a temporary dip in earnings per share and return on equity. If instead the firm uses the $100 million to buy back shares at $20 per share, it repurchases 5 million shares. Shares outstanding become 5 million, equity falls to $400 million. New earnings per share equals 100 divided by 5 equals $20, double. Return on equity equals 100 divided by 400 equals 25% higher. The buyback creates an anti-dilution effect that boosts per share metrics, which can lift the market price because many valuation multiples are per share. The key takeaway: buybacks directly improve earnings per share and return on equity by reducing the denominator, while dividends improve cash return to shareholders but may depress per share performance ratios in the short run. Tax treatment is a major driver of payout choice. In most jurisdictions, ordinary dividends are taxed at the individual's marginal income tax rate, for example, 30 to 37% in the United States, whereas capital gains are taxed only when realized and often at a lower rate, for example, 15 to 20% long-term. For shareholders, dividend receipt arrow tax now equals dividend times tax rate. Buyback arrow no tax until the shareholder sells the stock. If the stock price rises from P0 to P1, the taxable gain equals P1 minus P0 times shares held, taxed at the capital gain rate. This deferral can be valuable because investors can earn after-tax returns on the pre-tax cash for years before paying tax. For the firm, dividends are paid out of after-tax earnings, but the firm does not receive a tax deduction. A share repurchase is also funded with after-tax cash. However, if the firm uses debt to fund a buyback, the interest expense is tax-deductible, creating an additional tax shield, the leveraged buyback effect. Thus, when dividend tax rates exceed capital gain rates, buybacks are generally more tax-efficient for shareholders, while firms may favor dividends when they want to signal stability or when they lack cheap debt capacity. Two common valuation approaches embed payout policy differently. Dividend discount model, DDM. The firm is valued as the present value of expected future dividends. V0 equals sigma of dt over 1 plus r to the t. If the firm pays a constant dividend growth G, the Gordon growth model gives V0 equals D1 over R minus G. The DDM works well for mature firms with stable dividend policies, for example utilities. Adjusted present value, a PV with buybacks, that a PV separates the base case, all equity, value from the value of financing side effects. In a buyback-focused firm, the base case is the present value of operating cash flows, FCF, discounted at the unlevered cost of capital, RU. Then we add the value of the tax shield from debt, if any, and the value of the repurchase program, which is essentially a return of capital to shareholders. The buyback can be modeled as a reduction in outstanding shares, raising earnings per share and thus the market price. A PV equals present value of FCF plus present value of tax shield minus present value of repurchase cost. The last term is negative because cash is used. The DDM treats dividends as the only cash flow to equity, while a PV treats buybacks as a financing decision that indirectly benefits equity holders by changing share count and leverage. Matching the model to the firm's actual payout practice improves valuation accuracy. Target payout ratio, firms often set a long-run target, for example 40% of earnings based on industry norms and cash flow stability. The target can be expressed as target dividend equals tau times earnings, where tau is the desired payout fraction. If earnings fluctuate, the firm can use a flexible interim policy, for example a stable dividend that grows slowly, while retaining excess cash for growth or debt reduction. Free cash flow allocation. According to the agency cost view, cash should first cover investment projects with positive NPV, debt obligations, and any remaining free cash flow can be returned via dividends or buybacks. The optimal split is found by solving maximize shareholder value equals present value of investments plus present value of dividends plus present value of buybacks, subject to cash flow constraints. Dynamic trade-off models, real options thinking treats the payout decision as a sequence of choices over time. When future investment opportunities are uncertain, retaining cash provides flexibility, the option to invest. When the firm perceives its stock as undervalued, a buyback is optimal because it captures the upside for shareholders. VT equals the maximum of PT times DT plus beta times VT plus 1 if paying dividend, BT times BT plus beta times VT plus 1 if repurchasing, IT plus beta times VT plus 1 if investing. Where PT and BT are present value factors for dividend and buyback respectively. The solution yields a policy rule that switches between payout types as market conditions evolve. Payouts are a powerful communication tool because they convey information that is hard to hide. Dividends as a signal of stability. According to signaling theory, a firm that can sustain or raise dividends is likely confident about future cash flow. Investors interpret a dividend increase as a positive signal and may bid up the share price even if underlying earnings have not changed, yet the reverse holds for a dividend cut, which often triggers a price drop. Buybacks as a signal of undervaluation. When management believes the market price is below intrinsic value, they may repurchase shares. This action sends a buy low message. Empirically, share price reactions to announced buybacks are typically positive, reflecting the belief that insiders have superior information. Information asymmetry. If managers have private knowledge about future profitability, they can choose the payout channel that best matches the information they want to disclose. For example, a firm with volatile earnings may prefer a modest regular dividend to avoid frequent cuts and use opportunistic buybacks when the stock is cheap. This two-pronged approach reduces the chance of misinterpretation and aligns with the mixed signaling hypothesis. Overall, the market reads both the magnitude and timing of payouts, and consistent policies help build credibility, while unexpected changes can be interpreted as red flags. Assumptions: shares outstanding 10 million, share price $50, net income $200 million, cost of equity 10%, corporate tax rate 21%. Scenario A: $5 per share dividend. Cash paid equals $5 times 10 million equals $50 million. Equity after dividend equals $50 times 10 million minus 50 million equals $450 million. Earnings per share after dividend equals 200 million minus 50 million, divided by 10 million equals $15. Shareholder receives $5 cash taxed at 30%, resulting in $3.5 after tax. Total after-tax wealth equals $5 minus $1.5 equals $3.5 per share. No change in share count, so no dilution. Scenario B, $50 million buyback at $50 per share. Shares repurchased equals 50 million divided by 50 equals 1 million shares. Shares outstanding after buyback equals 9 million. Equity after buyback equals $500 million minus $50 million equals $450 million, same as dividend case. Earnings per share after buyback equals 200 million divided by 9 million, approximately $22.22, up from $20. Value per remaining share using cost of equity equals earnings per share divided by 0.1 equals $222.2, but actually market price adjusts and typically rises proportionally. New price approximately $55.56, since total equity $450 million divided by 9 million shares. Capital gain tax on the price increase is deferred until the investor sells. If the investor holds one share, after-tax wealth after a year, assuming price stays $55.56, equals $55.56 minus $50 cost equals $5.56 pre-tax gain. After-tax at 15% long-term capital gains equals $4.73. The buyback creates anti-dilution. Each share now represents a larger claim on earnings and assets, raising return on equity equals 200 million divided by 450 million equals 44.4% versus 40% before. Cost of capital impact. If the firm finances the buyback with debt, for example $30 million of debt at 5% interest, the interest tax shield equals 30 million times 5% times 21% equals $315,000, modestly raising adjusted present value. The added leverage also raises the equity cost of equity due to higher risk, which can be captured with the Hamada equation. RE equals unlevered cost of equity times 1 plus 1 minus tax rate times debt over equity. The example shows that while both payout methods return $50 million to shareholders, the buyback improves per share metrics and defers taxes, whereas the dividend provides immediate cash but can depress earnings per share and return on equity in the short run. Explanation. Below are 3 typical MBA-style questions on payout policy together with the approach you would use to answer them. Number 1. Calculation, dividend versus buyback impact. Question: a firm has 20 million shares trading at $30, earnings of $120 million, and a cost of equity of 12%. It can either pay a $1 dividend per share or repurchase shares worth $10 million. Compute the change in earnings per share, share price using the constant growth DDM with growth equal to 0, and total shareholder wealth under each option. Solution outline. Dividend, cash outflow $20 million. New equity $600 million minus $20 million equals $580 million. Earnings per share equals 120 minus 20 divided by 20, which is $5. Price equals earnings per share divided by the required return, $5 divided by 0.12, which is $41.67. Wealth per share equals $30 plus $1 cash, which is $31, ignoring tax. Buyback, shares repurchased equal $10 million divided by $30, which is 0.333 million shares. New share count 19.667 million shares. Earnings per share equals $120 million divided by 19.667 million shares, approximately $6.1. Price approximately $6.1 divided by 0.12, which is $50.83. Wealth per original share equals $50.83 times 19.667 divided by 20, approximately $49.9. Compare and discuss tax deferral. Number 2. Conceptual assay signaling. Question: explain how a sudden increase in dividend payout can be interpreted as a signal of firm quality. Discuss potential pitfalls of this signaling mechanism. Approach: define signaling theory. Describe the cash flow certainty argument. Use a simple payoff diagram: high-type versus low-type firm. Explain why only high-type firms can afford sustainable dividends. Then note issues such as pecking order conflicts, debt covenant restrictions, and the risk of overpaying dividends that drain future investment. Number 3, case analysis, optimal payout mix. Question: you are given a case of a technology company with volatile earnings, a strong balance sheet, and a low debt ratio. The board is debating whether to start a regular dividend, initiate a share repurchase program, or keep cash for research and development. Outline a decision framework you would apply and the key metrics you would calculate. Approach. Step 1. Forecast free cash flow and identify net present value positive projects. Step 2. Use the target payout ratio, for example 30% of average earnings, as a ceiling. Step 3. Run a sensitivity analysis on share price impact, using adjusted present value for buybacks versus dividend discount model for dividends. Step 4. Evaluate tax efficiency for the typical shareholder base. Step 5. Rank options by incremental shareholder value, delta adjusted present value. Conclude with a recommendation. For example, a modest buyback combined with a low fixed dividend to maintain flexibility. These sample questions test quantitative skills, the ability to translate theory into practice, and strategic